All right, so to review the worksheet, we've got it labeled 1, 2, 3, what happens first, second, third. So first, we have our heading, who, what, when. Okay. Second, we'll pull all of the counts from the chart of accounts. So basically, you grab your green book, okay, and in the worksheet that's in your blue book, you'll just start cash, petty cash, just going down that left-hand column, writing every name down. Okay? Yeah?
I don't think I ever got that.
We did this in class.
I don't
Okay.
remember.
I'll try to get some copies made possibly. Okay? Neither one of you? Okay. So this is something that if y'all are in a lull with somebody doing something that you can't help with, this is something else you can do besides the 31st payroll, is to just go write all these names down on that worksheet. Okay? All right, and then you have some of those being your balance sheet accounts and your income statement accounts, with income summary being the transitional point. Okay? Then 3, you bring your balances from the ledgers. So you go back to your green book, okay? And if you've posted everything correctly, then the ledgers should be accurate, and you're just going to go find the last total that you have and bring that into this column. Okay? If it's a debit here, it's a debit here. If it's a credit here, it's a credit here. Okay? Then you'll do the proving, and this is the proving of the ledgers right here, that all your debits equal all of your credits. Okay? After we've done that, then we'll start the end of fiscal period work, and the first thing that you see here is adjustment information. Okay? So that's step 5 of our worksheet. Okay? Our adjustments. What's been used up? And we always put in a debit and a credit. Okay? So this is where we look at, say, prepaid insurance. Okay, what did we start with? What did we end with? What's been used up? Credit, prepaid insurance, debit, insurance expense. Okay? So we'll kind of walk through that. And there's a couple adjustments that are new, and so that's kind of why we're going through today. Okay, which takes us to this page. One of the adjustments that we're going to make is an allowance for uncollectible accounts. Notes here, companies expect to get paid within 30 days. You know, we gave them a discount if they paid within 10, but it said 210 net 30 or N 30. That means we're expecting them to pay the full amount within 30 days. Sometimes that doesn't happen, and we may extend that. We may charge late fees or something like that. Sometimes we may never get paid, okay? And so we have to kind of plan for that, and that's what this is doing. It's planning for people not to pay us, unfortunately, okay? So we have an account called an allowance for uncollectible accounts. And it's a contra to accounts receivable. Because if everything that we receive from people is accounts receivable, okay, the allowance is reducing that because we don't think we're going to get it. Okay? So when we say contra, we mean opposite. Right? Here's your plus, here's your minus. That's normal balance because it's an asset. The allowance is a contra to that because it's going to reduce our accounts receivable. So it's a credit normal balance. Okay? When we actually do this adjustment, there's an expense count that goes with it. Okay? And so if this is a normal balance credit, the expense count is normal balance debit. Right? All expense accounts are normal balance debit. Okay? So this is where our adjustment will happen. These two are connected because one reduces the other. These two are actually how we do the adjustment. Okay? So there's a couple of different ways to do it. If we were actually going through the chapter on this, we would learn a couple of different ways of doing it. But we're abbreviating just what we need to know for our packet. Okay, so in our adjustment, it tells us that uncollectible account expense is estimated at 0.25% of the sales on account. Sales on account for the year equal 117,816.37. So it gives you the number. So we just have to calculate that. Okay, so for the percent of sales method, where it's 0.25% of, so we're going to multiply that, 117,816.37. Okay, and doing the math on that, 117,816.37 times 0.25% is 294.54. Okay, so that's the dollar amount that we have to adjust.
Is this the one that's actually in our?
This is the one that's actually in your book. So these are going to be your actual numbers.
What is 117,816?
It's the right here. It's the sales on account.
Should that be anywhere in your journal? That number?
No, that's why they're giving it to you. Okay, so then we're going to have adjusting entries. Okay, and this is what I'm showing you, so you can make this adjusting entry here. So this is always going to be in our general journal. Adjusting entries, closing entries are going to be in your general journal. Okay, and this is always going to be on the 31st for adjusting entries. Okay, and we have uncollectible accounts expense and the allowance for uncollectibles. We always want which one to go first? Debit. So this one's going to go first. Uncollectible account expense. For 294.54, and then allowance for uncollectible accounts is your credit. Yeah.
So I know the expense account is going to be closed out, but would the allowance for it be closed out?
It's a balance sheet account.
Oh.
Okay. Let's see. Actually, I should have done this one first. Well, I need to show you this. All right, so go to the other packet that you have now. Okay, so that's what an allowance is. Real quick lesson on that. Those are your actual numbers that you need for your book, so hold on to that. That'll be good to have. Okay. Next one, calculating federal income tax. So because we are a company that makes a profit, okay, or hopefully makes a profit, we have to pay taxes on that as the company, okay? And that's something we haven't looked at yet. Basically, what we're going to have to do is do some calculations to figure out what our net income before taxes are, and then actually make an adjustment for that. Okay, we're going to pay taxes as we go. If you look, Well, there's a couple things I want you to look at in your green book. Well, you don't have your green book. I'll show you here. All right, so first thing is I'm going to have to rethink how I talk about fit payable, right? So when we were doing our payroll, I said just use fit payable, okay? The problem with that is that then we start looking at these two accounts and we get a little confused, okay? So as you're posting payroll, salary, all that good stuff, that's all the employee income tax payable. That's employee fit, okay? Federal income tax payable is our company, okay? So before we start this end of fiscal period, please be sure that everything that you've put in here is in this ledger, okay? Not this one. When you did payroll, salary expense, all that kind of stuff, okay? And we recorded, or we posted, make sure we posted here. Does that make sense? Okay, so even in your, there should be nothing in this one until we get to this adjustment at the end. Okay, so you're gonna have to double check that because I let you put fit payable. So if you're posting, you might have thought this is where it went. So I'm gonna have to probably change how I teach that when we do payroll because of this. Okay, I'm not gonna let you abbreviate or let them abbreviate next year. Okay, then the other thing I want to show you is the expense account that goes along with the real fit payable. Omar? Okay. Here is the federal income tax expense. A company will usually estimate what their income tax is going to be. So for 2018, a company has estimated what they think their taxes are going to be, and they're going to pay them quarterly. So every 3 months, they're going to pay a little bit to the IRS so that they don't have to pay so much later on. Okay, they're going to spread that out a little bit. So what you see here is a balance. We've already paid the IRS $32,000, okay, based off of our estimate. So what we are doing here is finding out what our actual tax is going to be and make an adjustment for the difference. Okay, so you'll see that as we walk through it. Okay, so here is our tax schedule. Okay, here is our income statement credit column. Okay, so we're going to look, this will be coming off of our worksheet. Okay, income statement credit column, income statement debit column. The difference between those two is our net income before federal income taxes. Okay, so what is that? 650,000 minus 5300. Whoops. Minus. I know somebody's good at math and did that in their head. That's not 120. That sounds good. Okay. There's our net income before federal income taxes. Okay. Then we start looking at our tax table. Where does this number fall? Our net income falls right here, right? Between these two numbers. Okay. So we know that, let's see, of the amount over, we're going to pay $22,250 basically on the first 100,000. They've already got that calculated for us. And then whatever the difference is going to be taxed at 39%. Okay? So this minus this equals this. This number is coming from right here. and then we'll subtract to get our 20,000. Okay, our marginal tax rate is 39%. That number's coming from right there. We're going to multiply these two. So 20,000 times 30, 20,000 times 39% is 7,800 plus the minimum. Okay, this was based off the 100,000. Tells us what our entire tax bill is, plus 22,250. So we owe 30,050. Everybody see where those numbers come from? You draw the lines, because you're going to have to come back and reference this. Okay, so you will take, once you do all the adjustments that you need to do, except for this one, you will extend to your income statement columns. You'll take your credits minus your debits for the income statement, and that's going to be your net income before taxes. Okay, and there's actually yeah, I don't think we're gonna put that in because we have to put the adjustment in. Okay, then we'll use the tax table to find the actual taxes that we owe. Then we need to check our ledger. How much have we already paid this year? So this number right here, you can see, is coming from the general ledger. We paid this previously by quarter. Okay, so the difference between these two is what we still owe. So we still owe $2,050. Okay, so this is our adjustment amount. Now we'll go back in, we'll go to our table, our worksheet, we'll add that adjustment in, we'll extend those numbers across. Okay, and then we'll be able to find our net income after taxes. Okay, we'll also journalize that adjustment. Okay, so on the 31st, this is what your entry would look like for 2050 and fit payable, because this is something we're still going to owe. We haven't paid it yet. 2050. Okay, we're adding to our expense, and we're going to owe that much more money. Okay, so let me add another note up here. On the worksheet, wait to complete fit payable and the expense, federal income tax expense, until taxes calculated. Okay, we have all that?
Go a little further than.
Okay. Good? All right, now we're going to look at the other adjusting entries that we're going to have. Okay. This little section right here, these numbers are basically our trial balance numbers. Okay, so those came off of our ledgers. Now we have this account sitting here, it's been sitting here all year long, called merchandise inventory. Okay? Have we done anything with inventory?
No.
No. We bought product, right? What did we record that as? No? When we bought, like, merchandise? When we bought merchandise, what did we record it as? A purchase? Purchase. Okay? It's always been a purchase. We've never recorded it in inventory. A merchandise inventory account, which is on here, it's an asset account. Basically, that's a physical count of the inventory. Okay? We keep track of all the purchases coming in.